Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 12 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the 12th session on understanding mutual fund offer document and KIM. Alright, so now let's get started with our today's learning session and let us see what you should read in the offer document of a mutual fund scheme. Many investors often invest in mutual funds being convinced by the sales pitch of mutual fund distributors, agents, relationship managers. But are these sales pitches making you overlook, probably in excitement, some of the important facets for you to take the right investment decision in congruence to your risk profile? You see, simply getting swayed by tall claims in pursuit of getting wealthier is not the right approach to investing. You ought to take enough responsibility and be cognizant while investing in mutual funds so as to make a wise investment decision. Just as you compare the features of a gadget or the latest smartphone you wish to buy, it is imperative for you, while investing in a mutual fund, as well to read the Statement of Additional Information, Scheme Information Document (SID), or at least the Key Information Memorandum before you invest your hard-earned money in pursuit of earning returns and becoming wealthy. We often read what interests us. It may be a magazine, a novel, or it may be just a newspaper. But when it comes to investing, it becomes imperative to adopt the art of reading portions of the SID or KIM that are important and will help you make an appropriate investment decision. This session of our learning initiative does exactly that by educating you on important areas or portions of the SID which you should focus on and understand well before investing your hard-earned money in a particular mutual fund scheme. So let us understand each of these areas or portions of the SID in detail, but before that, let us understand what is meant by mutual fund offer document. Offer document or a prospectus from a mutual fund house is a document offering its schemes to the public for investing. Offer document consists of two parts: Statement of Additional Information (SAI) and Scheme Information Document (SID). While SAI contains all statutory information of the mutual fund house, SID carries important information about the scheme such as investment objective, asset allocation pattern, investment strategies, risk involved, benchmark indices for respective schemes, who will manage the scheme, and fees and expenses, amongst a host of others for making an informed investment decision. Both SID and SAI are prepared in the format prescribed by SEBI and submitted to SEBI. The content of the document needs to flow in the sequence prescribed in the format. In addition, the mutual fund is permitted to add any disclosure which it feels is material for the investor. So what to read in a scheme's information document? Number 1. Investment objective. You see, every mutual fund scheme has an investment objective and it is important to know the same before investing your hard-earned money. The investment objective explains the aim behind launching a particular mutual fund scheme and how it will be attained. Apart from this, most importantly, it clears the doubt created in the minds of investors due to the scheme names they sometimes carry. For example, monthly income plans do not guarantee monthly income, as also capital protection oriented funds do not guarantee protection to capital. Similarly, a high interest fund does not guarantee high interest income. Such ambiguities are clearly answered by mutual fund schemes' investment objectives, and therefore it is imperative for you to read it well, because the investment objective of the scheme could be far different than the one suiting your requirements. Then the next is asset allocation. This section of the information document indicates how a particular mutual fund scheme will allocate its assets under management to the respective asset classes such as equity, debt, and gold under normal market conditions. The asset allocation pattern indicates the allocation of the mutual fund scheme to various asset classes, and typically there is no fixed percentage that is mandated to invest in the respective asset classes. Instead, a range is provided indicating the minimum and maximum exposure to respective asset classes. For example, a range of 65% to 90% for equity asset class will indicate that the respective mutual fund scheme will allocate a minimum of 65% and a maximum of 90% of the total assets in equities. From the asset allocation, you can judge whether a mutual fund scheme is equity-oriented, debt-oriented, commodity-oriented, or is a hybrid scheme having a mandate to invest in different asset classes. Thus, this would give you as an investor a sense whether the respective mutual fund scheme can be appropriate fit for you depending upon your requirements. Once you have known the asset allocation and determined the orientation of a mutual fund scheme, that is equity, debt, commodity, or hybrid, the next section to focus on is the investment instruments the scheme would invest in. You see, within an asset class, there are numerous investment avenues. Thus say, as permitted by your risk appetite, if you choose to invest in an equity-oriented fund, it becomes imperative to assess which investment instruments the mutual fund scheme would invest in. For example, while investing in equities, if the scheme aims to have a high exposure towards riskier instruments such as derivatives, as it could weigh on the final returns generated by the mutual fund scheme. However, if a mutual fund scheme takes exposure to derivative instruments purely for hedging their position, then it may not turn out to be very high risk to investors. Also, the investment strategy should be clearly read. The investment strategy that the fund would follow in its pursuit of achieving its investment objectives is vital to know before investing in a mutual fund scheme. The investment strategy explains the approach the mutual fund scheme would adopt while selecting the instruments, equity, debt, or gold for investment. The investment strategy reflects the process and systems followed by the fund house as a whole. Such process-driven mutual fund schemes are better off as opposed to those that do not follow a clear strategy and depend solely upon the fund manager's ability to pick up instruments for the portfolio. Benchmark of the scheme. You see, it is vital to know how a particular mutual fund scheme benchmarks its performance. Essentially, a benchmark is selected so that suitable constituents of the same are structured in the portfolio of the respective mutual fund scheme as well. Then comes risk factors associated with the respective mutual fund scheme. By now, you may be aware that investing in mutual fund carries inherent risk for investing in capital markets. Risk, as you may be aware, hampers the value of your investments in the mutual fund scheme. So you should be aware of the risk involved and evaluate whether you are willing to take risks. Broadly, the risks involved in mutual fund investing are: number 1, liquidity risks, which indicates the risk stemming from a lack of marketability of investments held by a mutual fund scheme in its portfolio. Simply put, it impacts the buying and selling of securities, impairing the liquidity criteria of the portfolio. Thus, it is imperative to evaluate the investment mandate of a mutual fund scheme as to what market capitalization bias it would follow. Usually, stocks of large-sized companies are more liquid than smaller counterparts, especially the small-cap ones. Default risk. This risk is more relevant to debt holding of a mutual fund scheme, and it emanates from debt securities offered by companies unable to make their payments on debt obligation in terms of interest payment and repayment of principal amount. Here, it becomes imperative to assess the quality of instruments as conferred by the ratings that they hold in their portfolio. A highly rated debt portfolio is considered to be less risky than the one which has low rating. Settlement risk. This risk occurs on account of failure of one party to deliver the terms of contract with the other party at the time of settlement. So, a settlement risk can be infused at the time of settlement on account of default and any time differences in settlement between the two parties. Then the next is interest rate risk. You see, the changes in the interest rate scenario may also have a bearing on the scheme's net asset value or NAV, especially if it is a debt mutual fund scheme. Generally, the prices of debt instruments increase as interest rates decline and decrease as interest rates rise. They have an inverse relationship. Indian debt and government securities markets can be volatile, leading to possibility of movements up or down in fixed income securities and thereby to possible movements in the NAV. So for you as an investor, it is imperative to be cognizant about the interest rate cycles you are investing with and select the right mutual fund schemes for you to earn fruitful return on your investments. Reinvestment risk. Every investment in a debt portfolio is exposed to reinvestment risk. In case of debt securities, the interest rates prevailing at the time of maturity date and/or the coupon rate may differ from the original coupon the debt instrument offers. Consequently, the proceeds may get invested at lower rates, due to which there is a reinvestment risk. So one needs to be aware of this risk while investing in debt mutual fund schemes. Apart from the standard risk which we just learnt of, there are other scheme specific risks such as economic risk, currency risk, political risk that the respective mutual fund scheme may have a direct or indirect exposure to. For instance, in an offshore mutual fund scheme which invests your money in assets abroad, your investments are always exposed to respective country specific risks such as political risk and economic risk. In case of sector specific or thematic mutual fund schemes which invest in particular sector or a theme, the particular mutual fund scheme will be exposed to the developments taking place in that sector. Say for instance, a mutual fund scheme pertaining to the banking sector will be exposed to the interest rate risks along with the standard risks mentioned above. Hence, it is essential to know the standard risks as well as the scheme specific risks which you may be exposed to before investing your hard-earned money. You need to also know who will manage the scheme. Even if the mutual fund scheme which you wish to invest comes from the stable of a well-established fund house and has proper investment processes and systems in place, it is essential for you to know the fund manager managing your investments in that particular scheme. The fund manager's expertise is vital for overall performance of the scheme in the long run. The fund manager's experience, his or her track record, qualifications, etc. are some of the qualities you should be aware of. These details are highlighted in the scheme's information document. An experienced fund manager can enable creating alpha in the case of an actively managed mutual fund scheme. Then the next is past performance. In case you are investing in an existing mutual fund scheme, the information document of the respective schemes will also contain details about the past performance over various time frames. Past performance can be a guidance while making an investment decision, but should not be solely relied upon, as past performance cannot be an indication of future performance. While evaluating a mutual fund scheme, it is imperative to look at performance over longer time frames and not get lured by short-term performance, if any. Also, it is vital to assess whether the track record clocked by the respective mutual fund schemes meet the investment objectives laid out. Fees and expenses charged by the fund. It is noteworthy that your net returns from a particular scheme is directly proportional to the fees and the expenses charged by the fund house. As the mutual fund house has objective of making money for you, as for itself, it levies charges in the form of exit loads, switching charges and fund management fees amongst others. The charges and fees are deducted from a respective scheme's NAV, and thus you should ideally look for a mutual fund scheme which has a lower fees and expense ratio. Investment options. Please note that a mutual fund scheme offers its prospective investors various options for investing. The broader investment options available under a mutual fund schemes are growth and dividend, and under dividend option you have two sub-options, namely the dividend payout option and dividend reinvestment option. At the outset, you have different modes of investing in mutual funds, namely lump sum investments as well as SIP or systematic investment plan and STP, which is also known as systematic transfer plans, which help you benefit from the rupee cost averaging and compounding. You should opt for an option which suits your need and also the mode that is effective for you to create wealth in the long run. Then you should also judge the credibility. While reading the aspects which we just learnt of can help you judge a mutual fund scheme To judge the credibility of a mutual fund house, you must read two things in the offer document. First, investor grievance. You see, every fund has to disclose the status of investor grievances in the statement of additional information. The mutual fund house has to reveal the number of queries and complaints received towards a particular scheme and the complaints addressed. This information shows investors how proactive and responsive a fund can be towards investor grievances. Then the next is penalties and pending litigations. Likewise, every fund has to disclose the penalty imposed on the mutual fund house or the fund sponsor for any economic offense or violation of any securities laws in the SID. Also, they have to disclose any pending litigation or proceeding towards the mutual fund, fund house, trustees, associated companies, or directors of the mutual fund house. So reading such aspects in the offer document will help you judge the credibility of the fund house you are contemplating to invest your hard-earned money. Now let us shed some light on the next section in today's session, which is Key Information Memorandum. The Key Information Memorandum, also known as SKIM, is the abridged form of the scheme information document serving the cause of investors by mentioning the key sections of the offer document. It is noteworthy that the Securities and Exchange Board of India has pronounced a standard format for disclosures in this document, and it serves the interests of you investors because most of the relevant information which we just talked about is mentioned in the Key Information Memorandum. Moreover, Key Information Memorandum needs to be updated at least once a year. As per SEBI regulation, every application form needs to be accompanied by the Key Information Memorandum. Contents of the Key Information Memorandum. Key Information Memorandum carries the details of the mutual fund and the AMC, like the name of the mutual fund, its trustees, and the AMC. Scheme details like the name of the scheme, its investment objective, issue date, inception date, risk profile of the scheme, benchmark index, fund manager's name, etc. Minimum investment details, plans and options offered by the scheme. If it is an existing scheme, the performance of the scheme vis-a-vis its benchmark index over the last 1 year, 3 years, and 5 years, and since inception. Key Information Memorandum also contains details about loads and recurring expenses, contact details of the registrar and transfer agents who would process your transactions and take up investor grievances. And last, comparison of existing schemes is also mentioned in the Key Information Memorandum. Now let us take a look at some of the key takeaway points from today's session. The offer document can be a friend and a guide to enlighten you as an investor, provided you read it well, focusing on aspects which we just learnt about. So do not rush with investing. Ascertain the risk factors associated with the respective mutual fund scheme, investment objective, asset allocation that the fund would follow, investment instruments it would invest in, investment strategy that the fund will follow, against which index the fund would be benchmark its performance, who will manage the mutual fund scheme, past performance if it is an existing fund, investment options available for you to invest in, and judge the credibility. If you find reading the offer document voluminous, at least lay your hands on the Key Information Memorandum and read it well. This will help you to an extent. And last but not the least, get rid of the ignorance and be a responsible investor. This is because while ignorance is bliss, that may not be true in the world of personal finance and investing. Also, it may not yield you much in your journey to wealth creation. So to end our learning exercise today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.